We just got the data this morning on the unemployment claims. Total over 30 million people unemployed or have filed for unemployment since March 15th. About 20% of the people, it was about 152 million people were working. So 30 million of them have declared that they are now not working and asked for uninsurance claim. And incidentally, these are the folks that are supposed to be getting the extra $600 a week as part of the assistance from the federal government, which is interesting too. That's one reason perhaps this number is so high. It brings the unemployment rate up about 18%. We went into this this whole episode at an unemployment rate of plus or minus around 4%. Or a little bit less, and you know it doesn't go to the full 20 because, quite frankly, some of these people won't be considered part of the labor force. Texas unemployment claims. I'm going to show you some more details on these a little bit later on. The housing market, for those of you who are interested, obviously what we've got is March data. We don't have the April data yet, so it's still a little bit hazy exactly what the statistical influence is going to be. No doubt it's slowed down, and I'm sure that the people who are listening in could tell us anecdotally that it has. I can tell you that through March, the first half of March was pretty good. The second half of March was when the slowdown started, so it was down about 22%. This is nationally. I'll get to the state numbers here in a minute, but technically it was actually up a little bit year over year. From March a year ago, the down 22 was down from February. Permits are down. March Texas home sales were actually slightly positive. Prices were still up, so forth. Oils, yeah, you're all probably following what's going on there. We've got around $10 a barrel, and of course it's been going all over the place from a positive $20 a barrel to a negative $35 a barrel. And when it hit negative, that really got some people's attention. We've got nearly about 4 million mortgages, because these data get updated on a regular basis, that are now technically in forbearance, where borrowers, homeowners have contacted their lenders, their servicers, and asked for forbearance on the payment of their mortgage payments. That program is designed right now, or technically allowed for 4 months. So it would go through June. We'll have to see how this is going to work out. I'm going to go through a few slides here, and I hope that now you just saw me change it. Non-farm employment change per month. Technically for March, we were only down 700,000 jobs, but that's because the way the data are collected by the Bureau of Labor Statistics, they report the month, but they actually only are collecting the data through about the 12th of the month. So they really didn't pick up a lot of those unemployment filings that happened the last 2 weeks of the month. But you can see how by the history, you can see back to 2009 and 8 that we're approaching that. And quite frankly, when we get the April data and then we get the May data, it's going to drop on down a great deal more than what you're seeing here. Here's the weekly unemployment claims. I did get a chance to update this one this morning. The April 25th numbers came in. The good news, I suppose, is you can see that we peaked back on the end of March, rather, with almost 7 million filings and progressively 7, 6, 5, 4, 3 in the millions counts. So it is coming down. So there was this sudden surge of unemployment claims that have come in. It's still, and I've given you the history here back a couple of years so that you can see that by comparison on a monthly basis, these are just stratospheric numbers for filings that the typical, like on March 7th, March 14th, in the 200,000s, and then all of a sudden it jumps into the 3, 6, and 5 millions of people filing the unemployment claims. A lot of people are comparing to what I got during the Great Depression back in 1930s. Big difference. This has all happened in about 6 weeks. In the Depression in the 30s, it took about 1.5 years to get to this level. So the sudden collapse is what has got the attention, and we don't know how to handle it. We've never had a mandated, if you will, a government mandated shutdown of the economy, where we're all told basically to go home, stay in place, shelter in place, don't go out, don't buy anything. Restaurants closed down, everything goes, bars closed down, theaters closed down, all the sporting events and so forth. We've just simply never had anything like this, and this is the result for these kinds of things. Consumer confidence, and this is a biggie. I'm going to come back to the consumer confidence on you here in a little bit. This is still a March number. It's down 33% since January. You can see basically all of these charts I'm going to show you, the most recent data, it fell off the cliff, and it's still falling off the cliff. The good news was that, and the Consumer Confidence Index, the Conference Board actually measures about 7 or 8 different things. This is the overall index that I'm showing you on the graph, but there was one on future expectations. What do you expect it to look like 6 months, a year from now? And that one was not much different. It actually rose a little bit. People are optimistic, or at least trying to be optimistic on down the line into the future. And future here, in this case, reasonably near-term future, 6 months to a year out. I don't think if you asked them what they think about for the next 30 days, it'd be all that good. But if you ask them what they think it'll be in the next 180 days, the attitude is a great deal different. Retail sales have plummeted. They're down 8.7%. And you can see this is percent change on a monthly basis in the graph. And you can see how it does go up and down. 0809 was back over there, was in the negative category. The oil collapse in 19 caused retail sales to go down. But you can see how it, again, fell off the cliff. It's going to go further. Personal consumption expenditures are also down, which is the part of GDP that gets measured into GDP. And quite frankly, again, it's going to be the worst on record. It's going to be, these are historical lows or historical rate of change on a negative basis. And we're going to see that some more. Small businesses, the National Federation of Independent Businesses that survey small business operators and owners. And despite the PPP program, the payroll protection program and so forth, obviously small business can't be optimistic right now because most of them are shut down. Especially if they're in the retail or in the service business, people don't think about it, but the healthcare, doctors, dentists, and so forth who are seeing day-to-day patients, a lot of them are shut down. The hospitals are open, of course, trying to take care of the patients from the virus. But a lot of the day-to-day activities have shut down. And of course, we're all aware of what's going on with the theaters and the restaurants and the bars and retail stores of clothing and so forth of being down. This is going to be down, and this is going to be down some more before we get there. Interest rates, of course, are always of interest to those of us in the real estate business. The green line there is that federal funds rate. That's the rate that you talk about. The Federal Open Market Committee met last week, didn't change rates. It's still effectively a 0.25. That's the reason you see the green line doesn't actually touch the zero line, but it's just above it. So we measure it that way, but the range is 0 to 0.5%. The 10-year Treasury has fallen off the cliff. You can see where it is there. It's approaching that 0.5. It was at about a 0.6. These are monthly numbers. The 30-year fixed mortgage rate is interesting because it has been a little sticky coming down. It has fallen. It is down. It's down in that neighborhood of around 3.3%. And this varies by locality and by lender and so forth. And I'm aware, and this is for, incidentally, 20% down, FICO scores, 700 plus and so forth. Sort of your vanilla residential loan. If you want to go a 15-year loan and you've got equity down payment and so on, you can now get below 3 pretty easily if you find the lenders. The lenders are getting nervous. They are making the loans tougher, a little tighter. They're overriding some of the standards that have been set by FHFA, by FHA, too many alphabets in the federal government. Fannie Mae, Freddie Mac, Ginnie Mae, all of the others. While they'll set some standards there for what they want and what they will allow and buy the loans, the lenders are overlaying and making even more stringent requirements. JP Morgan Chase came out about a week and a half ago and said they're simply not going to make any residential loans other than 20% down and FICO scores over 700. So we're seeing the interest rate being sticky a little downward. One of the other reasons, too, incidentally, is that a lot of the lenders were overwhelmed with the refis. People wanting to refi as well as buy new, and they simply aren't staffed and equipped to handle the demand that was coming in. So there was they didn't feel any urgent need to have to lower the interest rates. They almost basically didn't want the extra business. Let me show you this particular slide is the World Economic Projections. And I know you're sitting there probably thinking, hey, I'm in the Dallas-Fort Worth market. Do I really care about this? Well, yeah, you do, because we're a major player in the world economy. And when I say we, I'm talking about the state of Texas, and Dallas-Fort Worth area is a major player at the international level. And we are very interested in the energy market, particularly the oil and gas market. And one of the reasons that market right now is in such disarray and falling apart is not the oversupply that we were talking about just 3 or 4 or 5 months ago, and the war with Russia and the price war with Russia and Saudi Arabia keeping production up. What's happened is the demand for oil globally has just fallen off the table. And you can see the projected 2020 rates of growth. United States is projected for the year, for the total year. And I'm going to show you some other numbers here in a minute. But this is annual numbers, being down about 6%. You can see what Europe is looking like there. You can see Japan down. But the one down, the bottom panel, the emerging markets, they're all, the overall projection is a negative 1% growth. Basically, I'm going to tell you right now, we are in a mandated recession. There's no two ways about it. We are in a recession right now. We're going to be in this recession for a while. And if I knew the exact answer to for how long, it'd be a genius. Nobody knows. That's one of those we don't have a clue statements. But it's going to take a while to get us out, and it's going to be necessary at the global level for China and India and Russia and some of Brazil and Mexico to get themselves out of their doldrums and get back on a positive scale. I see China's 1.2, but look what it was 6.1, and a couple of years ago it was in the 9s. Now they are projecting by 2021 that it'll be back up into the 9s again. That may be a little optimistic. Here's what's going on in the U.S. I found this slide. I thought you'd find it interesting. Here's a whole bunch of economists and groups here in the U.S. projecting what they think the second quarter. We're in the second quarter right now. We're at the end of the first month of the second quarter, and you can see it ranges from a -9 to a -50. First of all, it's all negative. The average is that these experts are all projecting on average about a 25 to 30% decline in our economy. They just came out yesterday morning with the first estimate of the first quarter of this year, and it's a -4.8%. Now, that number will get changed. The Bureau of Economic Analysis, the BEA, that measures the GDP and the growth and so forth, they do 3 measures. This is called the advanced measure. It's the first one. It'll get revised a couple of times. Most people thought the first quarter might not be quite that bad because it really wasn't until the second, the last 2 weeks of March that the economy just really started sliding. January and February were still pretty solid. So we'll have to see how this works out and how it plays. Here's what it looks like graphically. This annualized percent change in the real GDP, this is the minus 4.8 I was just talking about. You can see what it looked like the prior quarters. We were running, 1.9 to 3.1. I mean, it was right at that 2.1, 2.2 area, 2.5% a quarter. The first quarter was a negative 4.8. As you've probably heard a lot of economists say, our GDP in the U.S. is about 2/3 comprised of consumer spending. And the 25-cent economic term for that is personal consumption and expenditure. That's what the PCE is over there. And it was down 7.6%. Non-residential investment, that's the building of anything other than residential, was down 8%, almost 9%. Residential investment was still up. Apartments and single-family dwelling construction, and that's a good point. That's something we're going to probably try to hang our hat on here on a go-forward basis and see if we can't do something with that. Because as all of you in the business know, we're still short housing. Housing is still technically in short supply at the national level. We're talking about a shortage of about 2.5 million houses or units. Now that's single family, that's owner occupied units and rental units, but it's in that bracket. I've shown you just on the graph just for and I got question marks out there, that's the minus 30. That was that average projection of that economics group. This is what it would look like. You can see how this is going to be worst on record, and how it's going to look, at least on the statistical graphs. The Wall Street Journal does a survey of about 60 economists, plus or minus, and this was their March survey for what they thought, and it's in the same ballpark. I'll let you look at this again. GDP down about 25%, but you can see a big range from 7.5 to 42. The big question mark is third quarter, and then on into the fourth quarter, of whether or not and how quickly we are going to rebound from the mandatory voluntary shutdown of the economy, and just how quickly we can reopen the economy and bring it back up to snuff. And I got to tell you, if we have that 30% decline in the second quarter, it means the third quarter has got to increase almost 50% in order just to bring us back to even, because of the way the laws of statistics run. So it would take a tremendous bounce back in the third quarter. So really what we might be really looking at for a bounce back is the second half of the year, the 6 months of the second half of the year. Price of oil, best guess, who knows, going to bounce around. The June futures are coming out. There's a little bit of hope in that. We'll have to see. I was talking to some folks out in the Permian earlier this week by phone. The feeling out there is that sometime by this fall, late fall, we might be back into the 30-35 price bracket again. I don't know whether that's what they really expect or what they were just telling me they were hoping was going to happen. Home prices probably are going to go real slow this year. About 1% is what these guys are forecasting. Starts about a million 12 level. Inflation is not the issue, and of course, I'm just told you we're in a recession. It's not 96.4%. It's for sure. A lot of you want to know, and I'm getting the question a lot, what is the recovery going to look like? Well, I put the first line in a different color because it's one of those things. I was a professor for 15 years, and I found out with a class, if there was something really important that you wanted to get across, you had to say it about 5 or 6 times before it ever took hold. And so I'm going to say it again. The pace of recovery, of course, is going to be in stages, but the whole recovery is going to depend on those 30 million jobs, and I'll show you the Texas numbers here in a second. But all of these jobs and people that have been laid off or furloughed or have lost their jobs, it's going to be how fast the pace of the recovery of those jobs and people go back to work. And then their spending, their attitude about spending, what they're going to spend their money on, how they're going to spend it, the level of spending, and so forth. And I'm looking at the recovery is going to be, you can actually think about it in terms of short, medium, long term. We're going to be looking at the next 2 to 6 months, and that gets us through basically this quarter, the second quarter, and into the third quarter and the end of the third quarter. That there's going to be a lot going on. We all know that in Texas, the governor has announced that we're going to reopen some things, maybe at limited scale, 25% capacity, 30% capacity for restaurants and so forth. We'll have to see how that works out. Even if the restaurants do open and hire some of their staff back, will people go and want and feel comfortable going to a restaurant, even with the spacing and the social spacing and so forth? And then we'll have a medium term, and I think this is going to be the more critical part of the whole recovery, is the 6 to 12 months from now. It may take into that kind of a period of time before we really start seeing the return to the kind of economy that we were having here prior to the virus outbreak, and what we're used to. And then the long run recovery is, what are we going to learn from this, and how are things going to change? And we're anticipating some changes. Office market's going to change, the way people work, where they're going to live. We'll talk a little bit about that, but we're hearing from the real estate sector. We're hearing at the real estate center, we're hearing from the realtors and people around the state that the exurbs, the suburban and just beyond the suburbs of our metropolitan areas are actually picking up in activity as people are looking to perhaps leave the concentrated and densely populated or densely populated areas of downtown and move a little further out. We'll have to see how that works out. Builders are trying to figure out, okay, if people are going to be working from home, if that's one of the lasting results of all this, is it going to change my design of what kind of house I build? The smart house, if you will. It's going to have to be wired and so forth. Are we going to have V, U, L shape, W shape? W shape means that we would have a relapse in the number of cases, deaths, and so forth, and have to close down again and do it all over again. I don't know. We'll have to see how that goes. Job recovery by industry segments is going to be uneven. Some jobs are probably going to come back very quickly, and all those folks who got laid off or furloughed will get some of their jobs back. Some of the people, though, the hardest hit number of jobs has been in that service industry, the hotels, the motels, the restaurants, the bars, service workers, and so forth. And that could be uneven because in some cases, quite frankly, some of them might be economically better off to keep the unemployment insurance with the $600 a week supplement on top of it, at least until that runs out. And like I say, I think that program technically is scheduled to run out in June, but who knows if it gets pushed out. Also on the recovery, we're very interested in this part. Housing could well be the leader in bringing the rest of the economy up out of the doldrums. It's essential. There's going to be some pent-up demand. We're going to have historically low interest rates that could help boost the recovery if the lenders don't tighten up the granting of credit too terribly bad. We're going to have to see how that works out. But housing could well be one of the leading industry sectors that gets us out. Let me talk about Texas. It's really too soon. This is what we don't have a clue and don't really know and don't have models for this. So I'm not going to overwhelm you with a whole lot of stuff because it's too soon to really know or to tell. One of the good pieces of news is that on a relative basis, Texas has not been hit terribly hard by the virus. The U.S., of course, most of you are keeping track score, and these numbers are probably already out of date. I put them together about several days ago, and they're already out of date. But on relative basis, our cases, the number of COVID cases that have been detected, and the deaths, put it on a per million population basis, we're we just simply haven't been hit nearly as hard. Again, some of these specific numbers you see down there with California and Florida and Louisiana, the specific numbers have shift around almost on a daily basis, but the relative positions have stayed pretty consistent. So one of the reasons I know that Texas is looking to reopen the economy and be one of the leading states or early states for reopening the economy is that we quite frankly just haven't been hit nearly as hard as some of the others, and particularly given that we have Houston and Dallas and San Antonio and Austin. We have major metropolitan, highly populated areas, and we still haven't hit those kinds of things that's hit San Francisco and Chicago and Detroit and New York, of course. So we've been relatively in better shape. Here's that same kind of graph for Texas weekly unemployment claims. We're going the other way. We're increasing the number of claims. That the 437 just came out today, and I suspect that that's going to get revised, but that's what the official number is as of this morning out on the Texas Workforce Commission site. And it's we'll have to see how this goes. In March, we officially lost 50,000, almost 51,000 jobs, and had a 4.7% unemployment rate. We're going to see that the unemployment rate in Texas is probably going to approach easily at about 10% here pretty soon, if it's not already there. Like I say, the data we don't generally is calculated monthly, and then it's almost a lag of a month before you actually see the numbers. So you can see, but look at the March 14th number. Was in the 16,000s, and you can see those little black bars down there across the bottom. You can see how unemployment claims, insurance claims were so low and fairly consistent, just modest ups and downs, and then again hitting the stratosphere in terms of the weekly claims. I did pull the claims for the central Dallas-Fort Worth counties. They do produce it by the major counties. I don't have all of the counties in the area, but this is from the time period March 18th to April 18th. So it's not through the 25th, but it's the most recent data that I could find for you. So out of those claims, you can see there's about 282,000, 283,000 people who have filed for unemployment insurance in the four central counties, if you will, of the Dallas-Fort Worth metropolitan area. And the number will be a little higher if you add in the other surrounding counties, but generally they go down significantly from there. By comparison, Houston is about the same number. It's pretty close. And of course, Houston is getting hit a lot harder with the energy and the oil and gas downturn. Dallas-Fort Worth, as some of you've heard me say before, J.R. Ewing notwithstanding, Dallas-Fort Worth is really not the energy dominated economy that the rest of the world thinks it is, because they assume it's that way all over Texas. So Houston is getting hit much harder with that than Dallas-Fort Worth, or Austin or San Antonio for that matter. If you'll recall, back in 2015, 2016, when we had the big oil price decline and rig count decline then, a few years ago, Houston got hit pretty hard. Dallas-Fort Worth virtually didn't even feel it, went right on through. So not too much. This is all got to be laid to the feet of the COVID virus coming out. The leading economic index put out by the Dallas Fed. Again, this is the March number, doesn't have the April number yet. It's going to be, again, one of these graphs that shows you how it falls off the cliff. You can imagine that when we do a shading here, after we had the Great Recession and then we had the oil bust that I was just referring to, we're going to have the COVID bust or the COVID recession, or whatever name we're going to put to this. And it'll be, but it isn't over yet. And that curve is probably going to go down some more. Don't be surprised if it's down where that Great Recession, that real big dip over there on the left, if it doesn't go back down to that kind of level, maybe even break back through the 100 barrier. On an index, the 100 is the basic one. Oil and gas. Well, you know about that. I'm sure all of you have been reading about it in the paper and so forth. It was the negative price was actually for just 1 day, or 2 days, so it didn't stay there. It did get down, and on a day-to-day basis, though, it's been highly variable, going down to less than $10 a barrel on some days, and then coming back up into the higher teens. The weekly numbers, right now, I can tell you the latest weekly number was $24 a barrel. For 2 weeks ago, they haven't released last week yet. I just looked at it this morning, so that goes like that. The rig count is probably going to continue to slide on down. Don't be surprised if we don't see the rig count go back down toward that May 2016 bottom of 173. These are Texas rigs, not US. These are Texas rigs. So don't be surprised. And so this is going to take some time for the energy market, for the ONG, oil and gas production, the upstream part of the energy industry, to show any kind of significant recovery. I can tell you that, of course, Midland, Odessa have been hit pretty hard with that. Houston has been hit. Some of those jobs that were going to be lost from this have already occurred. They were already, they could already see sort of the handwriting on the wall earlier in the year that the price of oil was going to be declining anyway, with the issue with Russia and Saudi Arabia and so forth. So this predated the virus effect and the pandemic, and so some of the job losses that were going to be a result of the O&P and the price of oil falling already has been taken into the marketplace. For example, EIA came out, that's the Energy and Information Administration, came out and said the implied demand for gasoline. I don't know about all of y'all, but I haven't put gas in my truck in about 3 weeks. So, we're not going anywhere. We're not driving around, so nobody's buying any gasoline, which incidentally is a big problem for the state. I'll get to that here in just a second. Let's talk about Texas's recovery. It, as we've said, is going to be staged or phased in the reopening of the economy, and this is probably going to take months. And yet we have to be a little bit sympathetic, and we have to be a little bit empathetic to the powers that be, because never done this before, don't have any history to base this on, and having to do it and estimate what's going on in the best possible way to do it. And of course, you've got the healthcare professionals watching it very closely in terms of whether or not we're going to increase or decrease the number of cases and so forth. Key, again, job recovery, people being brought back to work, and the jobs here in Texas, just as it was for the United States, and consumer attitudes and spending. And then we're going to have to watch it. It's going to be businesses. Are businesses going to come back into business versus how many are going to go out of business? There are all kinds of estimates flying around, being discussed about how many of the businesses that have been forced to close down are basically in that being forced out of business and simply won't reopen. Particularly small businesses that lack capital and resources in order to carry themselves. The average you hear bandied about is that most businesses should have enough capital to carry for 4 months. Well, that's not true in a lot of cases. Even real estate businesses, brokerage businesses might find it difficult to keep in business for 4 months with no revenue. Anyway, energy market's going to be decimated. Again, we think housing should rebound reasonably well. Construction is still going on. I know I've talked to a lot of realtors. You guys can probably tell me better than I can tell you that there is still activity. There are still people looking to buy homes. There is still an ability to close, sign a contract and close. You can do it without even having to meet. I've talked to a couple of title companies, and they've told me that they are even still having in-person closings. They just limited the number of people, so it's 2 or 3 or 4 or 5 people sitting in a room at far ends of the table. We have a state that allows remote notarization, so that helps a lot. Home building is probably in a little bit of a down peak right now, or downturn right now, but should be able to come back. One of the things I was going to talk about, local governments, they're hit hard, and that state, county, city, with the price of oil down and the production down, production cuts being happening, the oil revenue to the state is down, vehicle road tax is down, sales tax revenue is down, all of those kinds of taxes. Now, the areas like school districts and cities and counties that rely primarily on property tax should be in pretty good shape, because that's not as an immediate hit that gets felt through the economy. But we are going to see and begin to start seeing, particularly cities and the state, having a hard time meeting their budgets and maintaining their service level and their employment level if they don't find a way to make up the lost revenues that have been prevalent here the last several weeks, and that are likely to continue for the next several months. Jobs, this is now problematic, that 2020 curve up there. This is for the Dallas-Plano-Irving area. This is the immediate, the east side of the Metrotex, if you will. We had expected it to be about a 2.5% to 3% growth rate. First quarter of the year was doing pretty well. It was actually up a little bit if you look at the monthly estimate numbers that were there, but all of the job losses that have now occurred and the rate at which they'll come back, end of the year numbers probably won't look quite this good. Let me jump into the housing market. 2019, as all of you knew, was a good year. The purple numbers over there are what we originally projected at the Real Estate Center for the year. You can see that we expected 2020 to be a good year, but like I said on the title slide, all bets are off, so forget it. Here's Dallas-Fort Worth. Sales in March, and incidentally, March is probably going to be the last good month for housing for the next couple of months. April and May are probably going to be way down on everything. The year-to-date sales were doing fine up through March. They were up 7%, even though the March sales themselves were slightly down at negative 0.5%. The number I would point out to you is the active listings. The listings were already starting. People are perhaps taking their house off the market if they had it listed, or hesitating to put it on the market until we get through the virus impact and get the economy rolling again. So I'm suspecting that, again, the next couple of months, there's going to be activity. It's not going to go away completely, but it won't be at the level, particularly if we compare it to this time last year, that it's just simply not going to be. Look at that month's inventory. That's what that MOI is, 2.2. That's the shortage I was talking about. And Dallas-Fort Worth really had a serious housing shortage of supply relative to active demand. That'll change now in the course of events, but we'll see how it comes back. Home sales were doing just fine. Home prices, of course, had been accelerating, but you'll see the blue line and the red line were beginning to kind of level out a little bit. They weren't on that rapid increase into 18 and 19. We'll have to see, and we're looking maybe it was about a 2% increase in 2020 or 2019 rather. 2020 probably is going to wind up being about flat to up slightly as we see it. Overall observations, if you will, about what's going on. The Fed is providing liquidity by buying the mortgage-backed securities. This is the Fannie Mae, the Freddie Mac, Ginnie Mae bonds that have to be issued to provide liquidity to buy purchase the mortgages that are originated. We got about 4 million plus homes in forbearance. About 10% of those, 10% of the total FHA loans out are in forbearance right now. Those were generally the riskier loans as well. About 6% for the GSE loans. One of the interesting things that we found, the National Multifamily Housing Council released the fact that on multifamily, the apartment market, didn't get hit nearly as badly in April as they thought that it might. They typically get about 92% rent collections in a normal month. And this past April, was about 89%. So it was down about 4%. But that was not as much of a hit as what they were anticipating. Now, May, we're going to have to see whether tenants are going to pay their rent. One of the good parts there is if they went unemployed and got to $600 a month and they were renting, they're not spending their money on anything else because nothing else has been available. So hopefully they'll have the money to be able to make the rent payments. Early reports indicate that some of the retail malls have only collected 10 to 25% of rent. These are the big malls. The big malls have been in trouble for a number of years. This may be one of those things that's going to speed up and be an impetus for the big malls to really have some problems. Housing starts, they're going to come back. The HMI, that's the Optimism index, if you will, or activity index for the home builders across the country. It fell 42 points to a record low of 30. Right now, the home builders are not looking real good, but I think they did indicate, and it was like the consumer attitudes, their expectations for a few months out are a lot better than what their current or their immediate expectations are. Here's what I'm talking about. This is the Housing Market Index, the HMI, that's put out by the National Association of Home Builders, a survey of builders around the country and their optimism about what's going on. This is the overall index of what current situation is. And you can see, again, another curve that simply fell off the cliff. It'll probably maybe even go a little bit lower, but I suspect that within the next couple of 3 months, maybe June, July, August, we'll start seeing that one bounce back up and coming back up. Homes are being delisted by sellers, buyers are delaying buying, but what that's doing is it's going to create some pent-up demand. And that pent-up demand is just going to be a question of when it gets released and when it comes back. I'm guessing that it'll be this summer and fall. We may find a very interesting phenomenon this year where typically we would be right in the middle of the busy buying season around the state and in Dallas-Fort Worth as well, here in April, May, June period. It may be July, August, and September going to be our best months of the year. We just have to see. The credit is getting tighter. That's the credit overlays by the lenders I was talking about. It's going to make mortgages a little bit more difficult. The lenders are going to be nervous about people going back to work or being able to go back to work and how secure their jobs are and their incomes. And then they're going to simply want better credit terms. They're going to, or credit scores. They're going to want higher FICO scores and maybe even higher down payments, and not be quite as anxious to make the 90%, 95% loans. The other part is those of you who are in the business, if you're trying to get your clients better than 80% loans, of course, they're still going to need PMI, and that's going to become a problem with the mortgage insurance companies because they have, it's the domino effect of getting the appraisals and the inspections done in order to facilitate all of that. On construction, we're getting reports back that a lot of people are increasingly halting projects. Basically, what they're doing is they're finishing anything that's already currently under construction, but they are slowing down or canceling things that haven't broken ground yet. There are some disruptions that are beginning to crop up in terms of shortages of materials. The PPE, you don't think about it, but the construction workers also wear masks and floor shoe coverings, booties, and so forth. And of course, now they've got to compete with all of the healthcare workers and so forth. And then materials that particularly coming in from China, all the LED lighting and other fixtures that we import from China are now beginning to slow down and become scarce. So that's becoming an issue. And the workers, of course. Growing number of suppliers are telling builders to start expecting late or canceled deliveries. And as you know, time is as big a cost in building a property or building a house as the actual material cost. If they can't get it in a timely fashion, it adds just as much to the cost as if the cost of the material itself directly went. And then we're seeing layoffs a little bit more widespread. We'll have to see how that works out, particularly with startups being limited. I've talked to a number of land developers around the state that had plans for either the next phase of development or a new development and so on, and they're simply putting them on hold here. The good news is they're putting them on hold temporarily. They're not necessarily canceling the projects, but they're putting them on hold until they see how all this is going to work out. If we can recover reasonably well in the next 2 to 6 months, then we can start expecting to see some of these projects come on back. Mortgage credit availability index by the MBAs, this is what I'm talking about, the tighter credit, it's dropped. Again, another one of these graphs that's falling off of the cliff. The loans that are in forbearance are increasing. The expectation is that by the end of this month and on into May, that some of this might start leveling out, because these are based on people approaching their servicers and asking for forbearance. It's the only way we have of getting a measure, but you can see how that has built up in a very short period of time over just the course of a month. In the case of housing, there's a lot of variables going on. I'm going to try and wrap this up. One of the key questions we're going to have here going forward on the medium term of my recovery discussion there a minute ago is how many of these properties that are in forbearance are going to wind up in foreclosures? Are we going to go through another wave of distressed properties, short sales, foreclosed properties, and so on? It's all a function of the degree and speed with which people are rehired, go back to work, get an income, get some stability in their employment, and then work out their repayments. And that's been an interesting phenomenon. Last week, the government declared we're going to have forbearance, but they didn't tell everybody how they were going to do it. And in fact, what I'm being told is that some of the mortgage servicers were telling people that, yeah, you can skip this month and next month and the next month, but 4 months from now, you got to make it all up in one payment. Well, that's not true. So be sure and stay abreast on that and advise your buyers and sellers of what's going on. The low interest rates are going to stimulate some demand, but again, it's going to be key. Everything keys on jobs coming back and spending. Construction, brokerage, sales practices. All of you are probably sitting there thinking about, I'm doing my business differently today than I did even just 30 days ago or 40 days ago. We're learning new technology, virtual tours, virtual closings or remote closings. The sales processes are changing. It was evolving a little slowly. You knew that all of the millennials and so forth were 99% of them were coming through the internet anyway, looking at properties online and so forth as their start. But that is now accelerating a whole lot more. Home construction, I think, will come back. I think it could be prime recovery activity, and it needs to be. We need to foster that, and hopefully that will, if this pent-up demand and just the growth in demand and the fact that we entered all this one short. And then finally, the basic truism, everybody's got to be somewhere, and occupancy rates are going to maintain. Rent payments are not going to jump up this year much because of all of the disruption in the marketplace. They're going to want some stability and then start some rent increases and see how it weeds out, if you will. But the housing demand is still going to be there. I appreciate it. I'm sitting here and I've been talking to my computer, but I hope you've enjoyed it and I hope it's been worthwhile. Thank you very much.